Welcome to episode 133 of Founders Unfiltered. I'm Aviral here with Mazin. We've been running this podcast for over 4 years now, and the goal's always been simple. Unscripted, honest conversations with Indian founders about what it really takes to build a company. We've always focused on the messy, unique, and often surprising process of building a company in India. Today's guest is building one of India's most impactful and also quietly building fintech companies. Axio is reimagining how credit works for millions of Indians. There's also Gaurav's second time on the podcast after a pretty decent time period. Gaurav is the co-founder and MD of Axio, which was formerly known as Capital Float when we spoke last. What started as a lending platform for small businesses is now a full-stack consumer credit company, serving over 10 million customers and having 2,000 crores of AUM. Axio's story is especially relevant now. The company is in the process of being acquired by Amazon, one of its earliest strategic backers. This episode is a deep dive into what it takes to scale a business, especially in a regulatory environment like fintech, how Gaurav's journey from an MBA at Stanford to managing a licensed NBFC shaped the company's evolution, and why they chose to go deep on trust, risk, and product in a category often dominated by speed and burn. In this episode, we'll get into how Axio evolved from SME lending to a consumer-first credit platform and how to build responsibly in a high-risk industry. Welcome to the podcast again, Gaurav.
Thank you so much, guys. Good to be back here again.
Gaurav, what book do you give the most?
So there is actually a book called Iron Hope. This is by an endurance athlete called James Lawrence, and he's done 100 full distance Ironmans in 100 days, and a personal Iron. And he wrote this book about his experience of doing 100 triathlons in 100 days, which is obviously like a miraculous feat. And so that book really describes what he went through mentally, physically, emotionally during those 100 days. And so that's become a real favorite book of mine. And as an endurance athlete myself, I have a few friends who are into triathlon as well. And so this is a book I've probably gifted to 10 different people over the last few months. It's a really fascinating read to see how he actually survived that.
Nice.
Which thinker has shaped your thinking the most recently?
I wouldn't call him a thinker per se, but again, as you'll see me reference sports and endurance over the course of this podcast, somebody like a David Goggins has actually kind of inspired me a lot, right? Particularly as I've entered the arena of triathlons and Ironman, to be able to do this gets very hard. And then there are days when you wake up, you don't want to train. There are days when work gets stressful. There are days when family gets stressful. And his kind of pearls of wisdom that he just drops on you and sometimes in typical Goggins style starts shouting at you, really gets you out of bed, gets you motivated. I think that's something that really kind of I get motivated by, and I really like to kind of listen to what his journey has been, how he's kind of survived it, and what are his kind of little small pearls of wisdom that gets him going out of bed every morning.
And who's David Goggins, if you can share it?
Yeah, sure. David Goggins is probably, people call him the world's toughest man, or the mentally toughest man. He was a Navy SEAL, and he had a lot of addiction problems in his early years or in his 20s, and then finally became a Navy SEAL. I think in his late 20s, dropped like 200 pounds, and since then has probably done and conquered the toughest endurance races that the world has to offer. And many times has done it with like knee injuries, back injuries, running ultra marathons of 200 kilometers in the desert while completely bleeding off his one hand and his one leg. So I think if you can think of mental resilience, the one name that kind of always pops up is David Goggins. And he actually is also now a motivational speaker, basically inspiring folks to be able to overcome any challenges they had, which in his case was weight loss, drug addiction, coming from a bad family, but still overcoming that and actually being a fantastic athlete and a human being.
Amazing. If you had to build a startup today which wasn't Axio, what industry would it be in and what would it be?
I'd love to do something in food. I'm very passionate about food. Now, obviously, a restaurant is not a startup because it's never going to be high growth. So that's probably a passion project at some point. But I'd still love to figure out something in the whole food delivery, quick commerce. And I know there's like a lot of hype around that and hundreds of people are chasing it. But for me, what gets me going is the ability to solve operational and logistics problems. And I think that's probably one of the toughest out there in terms of solving that. And obviously, the guys have done a fab job of Swiggy and Instamart and Zepto, Zomato. But if there was a way that I'd love to combine my passion for food and having the passion for kind of operational challenges, I'd like to find something around that space. And I know obviously everyone's going to say do something in AI but I still want to go back a little bit old school.
More physical.
Yeah, that's what gets me going. I like the physical aspect of logistics issues.
Yeah, maybe that's all that will remain after 15 years, solving physical problems.
The world has
But
to
cool.
come back to that at some point.
Yeah, correct. Full circle. Let's go back to day zero. What was the insight or frustration or the inspiration for starting Capital?
Yeah, so unlike a lot of founders who typically have experienced a problem themselves and then end up starting a business in that field because they were not well served or they had an issue. That was not the case with Shashank and I. So the two of us were at Stanford. We wanted to come back to India. We knew that we wanted to work together. We liked each other. We were friends. We had complementary skill sets, but we didn't know what we wanted to start, right? And so we actually went on a typical McKinsey style process of discovery. Shashank, my co-founder, is a ex-McKinsey consultant. And so we actually spent a year when we came back to India looking at different businesses where tech could actually play a role. Neither of us were techies, but having spent time in the Valley, we understood what that could do to businesses and how impactful it could be. And so we actually went down a process of looking at 10, 12 different ideas where tech could really be an interesting enabler. And finance and, financial services and lending kind of always came out at the top as one of the top problems because back then, and I'm talking like, 2013, 14, you didn't have any of the incumbent banks doing anything interesting in technology. You didn't have the digital infrastructure that we have today. You had the mushrooming of a lot of kind of interesting fintech startups in the US at that point in time. And in this country, obviously, lending and credit is always going to be a demand, right? So that's why we said, let's kind of see how does this play out if we can use technology to disrupt lending to kind of make it more easier for the customer, even though it was not a problem for us per se, but it kind of I think the motivation to create a large business and being tech enabled kind of pushed us into this journey of seeing how it could actually make a big difference in financial services and particularly in credit.
Understood. And how were the early days starting up? If you can also talk a little bit about the ecosystem then, because you're one of the early founders in the ecosystem too. How is that? How is it coming back from the US to India?
Yeah, back then actually it was obviously a much smaller ecosystem. When we came back, it was easy to actually, open doors and meet a lot of VCs, which I still think is hard for a lot of people today as well. But having come from Stanford, having been a much smaller ecosystem back then, I think for us to be able to go and talk to people, right, was not a hard problem, and that was interesting because we got a lot of interesting feedback when we started, walling ideas off people, investors, certain other founders who were there back then. Um, the one theme that came out for us is like, you guys are from Stanford, you're from Silicon Valley, y'all cannot do credit in India, y'all don't have what it takes to roll up your sleeves and do as they would call, a dirty collections business in this country. And that kind of stuck with us, right? And so the first year was, I would say, extremely hard to convince an investor to write a check saying, hey, we are going to come uh, and try and do something different in lending, which was an age-old industry. But also it was quite difficult to convince, our team, our early core team, because we needed folks with some credit background. We needed folks with some tech background. And a lot of them thought that we were smoking crack. Like, what are you guys going to do in lending? So the first year was definitely hard. We didn't get much traction at all. And there were points in that first year where Shashank and I like, should we just go and do something else? But we kind of stuck with it. We got our first check from an investor. And that gave our first loan, I think, in 2013 end or 2014 beginning. And that was kind of how the journey started.
It doesn't seem like the Stanford MBA was all that of a golden ticket, although it would seem like today you had to struggle in the early days too.
Yeah. I mean, see, the golden ticket was it definitely helped to open doors. It didn't do much beyond that. Probably, I think had we chosen a different industry, the Stanford education would have been a lot easier. But like I said, people thinking that we were trying to disrupt an age-old collections-focused industry with technology, that kind of didn't fit well with the Stanford MBA education, right? And probably hurt us than helped us in the first year or so. But I think overall at Stanford, I think the tools that it enabled us with, right? Just in terms of how do you look at a business, how do you look at the economics of a business, how do you kind of meet investors, how do you pitch? I think those were like amazing kind of assets that the MBA gave us, and forever grateful and thankful to that university.
And in the last, it's been almost 12 years. Is there any point which you would say was the hardest moment in the journey?
Oh, yeah, for sure. So I think in 2019, we were going through an NBFC crisis in the country when, you had ILFS and that crash that happened. It was equivalent to the Lehman crisis back then. It was around that point in time where we were probably riding very high, and probably I'd say fairly overconfident. We had grown the business quite well. We had diverse products. We had probably done more than we should have. And when this crisis hit, like it came down like a real punch in the gut where suddenly liquidity dried up from the system. We were a loss-making company back then, and all debt lines were pulled. At the same time, we were in the middle of another acquisition at that point in time, which didn't pan out in the last minute, right? We were in talks with an investor, did like 8 months of diligence, on the verge of signing the deal, and the investor backed out literally like a few days before the deal consummation. So,
And was this because of the crisis as well?
that's what they would like to say.
Okay.
But honestly, I still don't know the reason till date why that acquisition failed. And I'd love to at some point. But I think that double whammy of having, being in a bad macro, or probably the worst macro that the industry had seen, a failed acquisition, and literally within 3-4 months plunging into COVID, where every industry was kind of suffering. I think that 6 to 9 month period was definitely the hardest for us as a business, for sure, but even personally, because it just kind of took its toll on the two of us. It took its toll on the business. We had to let go of a lot of people and literally rebuild the business from scratch. And which is hard to do in a lending business. It's hard to do in any business, but particularly in a lending business because you've taken debt from others, right? At least equity investors understand there's risk associated, but debt is something you got to pay back. And becomes very hard when you have to retool the business in the middle of a macro cycle when you owe about 1,000 odd crores to banks. That was probably the hardest time for us as the business. That period of, like I said, 6 to 12 months. And I'm glad that's actually behind us now.
Did you start endurance training around then, or?
That's spot on. I actually started around 21-ish at the fag end of this period.
Understood. And if you had to give your younger self a piece of advice when starting Capital Float today, what would it be?
This sounds a little cliche, but you have to know your investor. We made a lot of mistakes in taking money because an investor promised us a high valuation. We took the money. We're like, yeah, damn good. We got, I don't know, back then was like 100 million pre-money. The two of us were very happy. And that just proved to be a bad decision, right? Not getting along with people who you work with, whether that's an investor or people that you hire, I think these are some of the key lessons that I've at least learned over the last few years. Because, as they say, life is kind of short, but you want to really enjoy the people you are with, whether that's your co-founder, whether that's your investors, or whether that's people. And Shashank and I made a lot of hiring mistakes as well. And it took us a long time to actually correct those mistakes. So we ended up living with people, whether that's investors or whether that's employees, and not correcting those mistakes. And so if there's really one thing that I would tell my younger self is, A, pick and choose the right folks for fit rather than just for any vanity metric. And two, even when it goes wrong, just course correct very quickly.
Great advice. And with that, transitioning into your more recent journey, the shift from Capital Flow to Axio, it's more than a rebrand. What was the moment of clarity, if there was one, that kind of made you rethink your positioning?
Yeah, it was like I said, around this period of 2019, 2020, where we had three different customer segments. We had lending to small businesses, we had lending to consumers, and we had lending to like gig workers like Ola, Uber drivers, etc. Right? And going into COVID, it just seemed that we were too diversified. Um, that's when we actually took the hard decision to, stop our small business lending, stop our gig worker lending, and focus just on the consumer checkout finance business that we were doing. We had just started with Amazon on the checkout finance business. It was around 2019 end, and just when COVID hit, what we saw was something phenomenal, that because we were able to provide credit on a platform like Amazon, and people who obviously during COVID couldn't go outside and shop, the product adoption just went through the roof. We had I think a couple of million customers in that first year of COVID, because everybody wanted like a short-term line of credit and obviously wanted to shop on Amazon because they didn't want to go out and shop given COVID. And so once we started to see this, there was just an aha moment that, okay, obviously there is a COVID impact here, but we just felt that the need for credit and embedded into a platform such as Amazon, there was actually magic that was starting to happen. And that's when we said, okay, we have limited resources at this point. Let's just cut down everything that doesn't make sense or doesn't feel core. And so we stopped doing the small business lending piece. Backed by the growth on Amazon, we really doubled down and focused on the consumer lending piece. And as we did that, we realized that Capital Fort was, seemed like a more SME business focused brand. And we wanted something that was a little bit core to customers, to consumers, and would also kind of make them feel good about themselves while they took credit. So Axio means kind of worthy, and we wanted to make people feel worthy of credit. And so this shift, as it happened from small business to consumer, but also a company that was kind of going through its own journey, really felt like a change of sorts, both for us, for the company, as well as hopefully for the customer. So it was in many ways the change from Capital Flow to Axio was well timed with the whole shift in business strategy from small business to consumer.
And about that, I mean, it's a shift in strategy that means you now have an embedded checkout experience. You don't directly own the customers. What's your thought process on that? And, obviously that was a trade-off that you thought was worth it, but I mean, was that a difficult decision, or it was just clear from the data?
Honestly, I think we sometimes get too overly obsessed and worried about owning the customer. Boss, our product is a loan. The guy is coming because he wants credit. Now, if I don't give it to him, he's going to go get it from somewhere else. Now, okay, I mean, what does owning the customer really mean? I'm only worried that he takes the money and pays it back. Now, the biggest problem in lending is two things, right? One is managing credit default and two is managing CAC. It's very hard to actually solve the CAC problem in lending because you're always running into adverse select. You go to Google or you go to Facebook or you get app downloads, you're essentially targeting people who are desperately seeking for loans, right? So you're paying a high CAC for probably the worst customers, right? Who are staying up at the middle of the night and searching for a loan. Those are not the folks you want to be lending to. So you're paying the CAC, you're getting the worst customer. And so we just said that model doesn't make sense, which is why we wanted to make credit contextual, right? And we said embedded is a right play for us. We were always doing it sort of on the SME side, but we saw a better fit on the customer side. And we weren't the inventors of this, right? Bajaj Finance has been doing this for, 20 years. They just embed a guy in the store. We were just embedding an API or an SDK into the Amazon platform, right? So it's just old wine in a new bottle. People, contextual credit works, and we were able to kind of give it a spin that really just worked like magic for customers, because they're shopping, they're checking out on Amazon, they're checking out on Make My Trip. Within a couple of minutes, they're able to get credit. And most of the time, that credit is interest free. So it is the merchant that ends up paying the interest. And so for the customer, it's just about, rather than paying the 20,000 rupees upfront, they can split it over 6 months.
The value proposition definitely makes sense, but how do you actually underwrite first-time users? What are some of the signals that you think are good predictors of creditworthiness?
I mean, there's obviously the standard one that everyone uses, which is the bureau, right? The good thing in India is the credit bureaus now have at least 400 million people coverage, so that's a good starting point. And of all the customers that we see coming in through our various platforms, 60-70% of them have a footprint on the bureau. But that's not enough, right? Because the bureau mostly tells you intent. Has this guy taken loans in the past? Is he good at paying back? So it's more of an intentional kind of score. It doesn't tell you the ability of the person, right? What's his financial backing? Can he afford to repay the loan? Obviously, for a small loan, you can't ask the guy to submit a bank statement, or you can't make it too intrusive. So this is where, e-commerce data, shopping data, digital footprint, these things matter a lot. Now, they are interesting proxies to be able to start a customer on a small credit, and then you grow with the customer. That's really been the model for us, right? So we look at these data signals, whether it's shopping, whether it's the bureau, whether it's their online footprint, start the customer with a low line and then grow with them. So the entire low and grow approach is very critical to managing the CX element as well as managing the risk element.
No, that makes sense. And talking about how you structure the business, you operate as an NBFC. What edge does that give you? And, what is your maybe advice for people who are thinking about starting a fintech and going through that process?
Yeah, I mean, in fintech, you're going to be regulated even if you don't want to be regulated, right? So you can choose to have fancy structures and call them what you want and try to sit outside the regulatory environment. But the regulator is coming and the regulator is watching. So you might as well take the hard path of getting the right licenses and being regulated properly, because ultimately that becomes a moat in the business, right? You don't feel like it on most days because compliance burdens are hard, it's expensive, and lot of changes in the regulatory environment, particularly in the last, I would say, 3 to 4 years. But ultimately, when you take a step back, right, you're part of a system where it's designed to kind of make sure there are breaks put. But if you're able to navigate that, I think you're always kind of setting an edge, because you built a muscle that most people are not able to do. Right? We've seen in the fintech industry, a lot of people have crashed and burned because regulation changed overnight and they couldn't keep up. So if you can build that muscle, you're actually setting up for a long-term business. And while regulation changes, there's method to the madness. If you look at a lot of the regulations that have come out in the last few years, they could have been implemented better, but there's logic to what the regulator says. And there's a lot of thought process put, because they've obviously seen this for decades. They've taken inspiration from other regulators. So how do you think about, customers? How do you kind of make sure that customers are not getting screwed in the process? These things, if you can really start to develop a moat through a regulatory license, I think that makes a lot of sense to kind of get. Because like I said, in financial services, whether you want it or not, you're going to be regulated in some shape or form.
No, that definitely makes sense. But talking about a moat, consumer fintech is obviously a crowded space, and you guys want the first to do it. What is it that builds that kind of defensibility? Is it tech, data, brand, or something else?
I'd say tech, data, brand, everything you said is 50% of the business. The other 50% is, boss, as a lender, if you can't do collections, there is no moat. So I think one thing that we learned the hard way is the ability to collect. So we actually built not just teams and kind of in-housed entire collections over the last 5 years, which most fintechs didn't do, but we actually built interesting tech around collections, right? How do you predict who's going to pay? What kind of communications do you send? How do you manage the cost of collections? How do you kind of have enough people but don't have too many people? I think this collections as a muscle has become core to how we built the business. And I would say that's definitely a USP of our business. Now, you had all these large banks and NBFCs who were always great at it, and that's how they ran their business. But we tried to put a bit of a spin on it and see how does collections work in a more digital manner, and how do you kind of make people in the collections process a lot more efficient. Yes, you got to be empathetic to customers, but at the same time, you can't be taken advantage of, right? You have to draw a line. You have to be good at collections. Otherwise, no matter what consumer credit company you're building, you're not going to be successful.
Makes sense. And to go back to the Amazon partnership, I mean, it was obviously a huge distribution win and you'd really double down on it. But how did that come about and how did you make that work and scale it?
Yeah, funnily enough, and Aviral, I think you asked the question in terms of Stanford, right? So when we came back, one of our business school friends, or rather senior from business school, was working at Amazon, and this was the time when Amazon itself in India was kind of just getting started, right? And so we were chatting with him and said, hey, as you guys start to grow, your sellers on your marketplace are going to need credit. Why don't we start to think through some credit option for your sellers, because they are going to have to buy inventory, etc., right? So that's really how I would say the first few conversations and partnerships with Amazon started, which was, I would say, 2014, where Shashank and I went and spent a lot of time interviewing and meeting Amazon sellers and actually gave them credit. So for the first few years, we were actually, like I said, a small business lender focused a lot on sellers on marketplaces, Amazon, Flipkart, etc., right? And as that program and product started to grow, we developed a good rapport with the folks at Amazon. And as they were thinking about launching a credit product from the consumer side, they approached us and said, hey, you obviously know our system well enough. You've been working with our sellers. Why don't we try something on the consumer side? And that's really how the conversation started. And we timed it in such a way that as we were starting this, we were also in the process of raising equity. So we said, hey, why don't you guys come on as a equity investor as well? And we make this a very close-knit partnership with mutual exclusivity for the first couple of years, right? So I think a lot of it worked because A, we believed in the fundamental problem that we are solving, that credit at checkout makes sense. Two, we had a partner like Amazon that obviously had a very long-term vision and knew this would kind of work, and who, more importantly, also trusted us that we were the right guys. And I think three was just being able to deliver on that partnership day in and day out during hard times as what's kept the partnership going.
Would love to understand a bit more about that partnership, right? What did Amazon bring to the table and what did you bring more importantly? Like, why wouldn't Amazon just go and do this themselves?
So I think what we bring to the table is the ability to create, lending journeys that are very simplified and have a great CX for the customer. Amazon, as we all know, is obsessed about customers, obsessed about customer experience. And I think as they were looking at lenders, they obviously spoke to banks, spoke to large NBFCs. But I don't think any of those companies were able to deliver on a tech and a CX journey that would meet the standards of Amazon, right? So on the customer side, for example, we have to be able to give a loan in a matter of a few seconds, right? At the same time, we need to hold to tech SLAs and payment success rates of like 99.9%, right? I think that combination that we were able to bring in terms of designing a good customer journey, managing the tech SLAs that Amazon has, but bringing our underwriting and collection capabilities, I think that fusion really made them choose us and obviously continue working with us. In terms of what Amazon brought to the table, obviously, I mean, the biggest advantage of Amazon is that it's a massive distribution island, right? They sell everything under the sun. And so it was far easier for us to think of making credit contextual on a platform like Amazon, where you could buy a grocery item for a few $100, or you could buy a mobile phone for like a lakh of rupees, right? Because you're covering the entire spectrum of a customer's needs. So Amazon obviously brought their might of their, customer funnel. They actually taught us a lot on tech as well, right? What it really means to deliver at scale, right? You're giving credit at Diwali at 12 o'clock at night when the sale goes live, and you're seeing like a few million people log in to buy at that point of time. Your systems cannot fail, right? Because if it fails at that point in time, and that's like their main day of business throughout the entire year, what that takes to deliver at that scale and at that efficiency, I think we learned a lot about that from Amazon.
Amazing. And, maybe looking at how trends are evolving, in India, and given you've seen the space, if you had to bet on one fintech trend that's underappreciated and one that's overhyped, what would they be?
Underappreciated, I think something in insurance. I think people are still barely scratching the surface, right? In terms of insurance penetration, there are good companies that are trying to do, you know, different forms of health insurance, auto insurance, you know, bite-sized kind of uh, insurance. But I still think the level of under-penetration on insurance is massive. And I think the incumbent players are still going after the top 50, 100 million people. So I'd love to figure out at some point what to do there and how that problem can be solved. I think overhyped, I have to go to still. I mean, I may be going against the grain here, but the entire crypto, Bitcoin, I'm still not completely sold on that. Obviously, I see the merits and advantages and all of that, but till I can find a practical use case in this country for it, I err on the side of skepticism there.
Understood. And 10 years from now, when people talk about Axio, what do you hope they say?
I think two things. One, I think that I would love for them to say that we were an innovative company, right? And we kept up with that innovation year after year and started delivering products that were kind of interesting to folks. At the same time, if I just take a step back, I'd love for people who work at Axio to say that we were a good employer. I think that's very, very important. Uh, I hope they do today. And 10 years from now, particularly, I hope they can all look back and say that the best experience of their professional journey was the time that they spent at Axio. That would definitely mean a lot.
Super. And to close out, and why we call this Founders Unfiltered, what's some unfiltered feedback that you received that really impacted you personally or professionally?
You know, like I said, in the first year, we had an investor, and excuse my language if you have to edit this out, but he said, "You guys are not asshole enough to collect money in this country." Exact words. And he said, "That's why I will not write you a check." And that hurt. And the funny thing is, it was true for the first 5 years. We were not. But then we really learned what it took. And I think while that's an example, I think the ability to kind of understand what is, what really works in a business. Now, in lending, it is obviously the ability to collect in other businesses, other things. I think for somebody to tell you that you will not understand the core of the business starts to kind of pinch hard. And I think while that hurt at that point in time, I think today we are very grateful to that individual because though we didn't see it then, we definitely see what he meant now, and he said it with the best of intentions. And so we actually respect him for having said that.
Super. Gaurav, thank you for your time again. Love seeing the company and your journey evolve over the years. I hope a lot of our listeners will learn about how to build a fintech as well through this.
Thanks, folks. As always, love chatting with you guys and look forward to speaking again soon sometime.